Hello, everybody. I want to try something new this time. It's been a while since we sent out the last newsletter, and there's been a lot of changes that we've made to portfolios in the last 6, 7 weeks. In mid-August, we did a big reset on portfolios. I did send something, but I found that people have a lot of questions to the new strategy. And so I thought kind of walking through things a little bit on a whiteboard on what we see happening and how the strategy works will be helpful. The bottom line on it is those changes we made in mid-August were very, very helpful to preserving the portfolio. Our entire model right now revolves around two things. One is protect, and then two is to grow. But it's a challenging environment to do that. And right now we see that there's a lot of downside risk, and we want to be protected against that while at the same time looking for opportunities to grow the portfolio. And so the bottom line on the model portfolios, a lot of individuals have things that are different in the model that's been customized, or we've added things, but the overall model for most people is down less than 1% since mid-August, and the indexes are down about 17%. The stock indexes, the bond index is down about 4%. So I just want to walk into how that works and what we're doing and why there are so many trades and what to expect going forward and what our aim is through this market. So the fundamental thesis that we have is that if you look what happened during COVID, it really goes back to then. Is we had two things that happened. One is we had a real decrease in productivity from people staying home, right? We produced less stuff, GDP went through the floor. And the other thing we did as a country is we spent and printed a lot of money, about $6 trillion. And so when you have this happen, so this is new money, what's called M2. So government debt through government printing. The government can raise money through taxes, through borrowing, or through printing. And when you print it, that's when you increase the total money supply. When you borrow it, you're just moving around the money supply. When you tax it, you're just moving it around. When you print it, we increased the total money supply faster and higher, much faster and much higher than we ever had before. Whereas productivity went down. It's okay to increase money supply, but what should happen is that money supply should increase with productivity. And so if you increase the money supply with the increases in productivity, you get a stable currency. But when you increase the money supply faster than you do productivity, what you get is you get inflation. Inflation is nothing besides money being worth less. Too many dollars chasing too few goods. And so historically, governments have always done this when we have too much debt. So too much debt leads to printing money. Okay, so in February of last year, after the new administration came in, they passed a $2 trillion spending package and monetized it through printing. And then very shortly after that, we started seeing the inflation. Okay. And so that's what we're dealing with now. Now, inflation has some effects on how on your investments. The first thing that inflation does is it leads to higher interest rates. Okay, so there's something called a real interest rate. Whenever you see real, it means after inflation. So like real GDP is GDP after inflation. So the reason that GDP has been negative is because inflation's been so high. And real interest rates is interest rates minus inflation. Okay. So if the 10-year treasury is bouncing around a lot, but let's just say it's 3.5%. Inflation it's a little higher than this, but for round numbers, it's 8%. So 3.5 minus 8% is for negative 4.5%. Okay. And so investors don't like getting a negative real rate of return. And so over time, what happens is as inflation goes up, interest rates will go up. It should slightly exceed it at some point in time. And the reason this has to happen is because when you have negative interest rates, it's essentially incentivizing people to borrow money and spend it. So this is negative rates down here. And that borrowing money and spending it causes inflation. So the fact that we have negative interest rates right now is going to continue causing pressure on inflation to persist. And so to get that to stop being negative, you have to get interest rates higher than the inflation rate. Or you have to have the inflation rate come down. And what would cause that to have happen is a recession. And so if you look in the 1970s, the last time we had persistent inflation, you had three things happen. You had the printing of money, the new M2. Two is you would get inflation. And three, you would get a recession. So recessions didn't used to be political, but somehow they are now. And historically, a recession was always defined as 2 negative quarters of real GDP and negative real GDP. And we've had that. The reason I guess people would argue that we're not in a recession right now is because we haven't had a couple other things have happened. The next one is where you have a decrease in earnings. Companies are making less money. And a lot of companies are making less money now, profits, than they were. But as a whole, the S&P 500's earnings have not gone down. We'll see in Q3, but so far through Q2, as a whole, they haven't gone down. And then when that happens, you get the third component of a recession, which is unemployment. Okay? Because when companies start making less money to preserve their profits, they cut expenses, and a big part of that is laying off their workforce. We're starting to see this. You can see this, especially with tech companies. So you're seeing a slowing in hiring and you're seeing unemployment. So this is the process that's continuing. Now, that's the effect on interest rates. The interest rates have an effect on the stock market. And the reason is because the higher interest rates are, the less willing people are to pay for stocks. Kind of makes sense. Like if you can only get 1% interest, the stocks look a lot better than if you can get 4% interest, right? And so, there are bonds out there where you can get even 6 to 10%. You have to take the risk, but 6 to 10% interest. Maybe you could argue less risk than the stock market though. So as interest rates go up, it causes two things to happen. One is it causes bond values to go down. So old bonds become worth less. Okay? So when bonds come down, so interest rates go up, bond values go down. Okay? And it's pretty straightforward. It's not intuitive, but it's pretty. If you bought a bond for 1% a year ago, and now you can get them for 4% today, which one would you rather have? You'd obviously buy the new one versus the old one. So the only way to sell the old one is what's called discounted. So you might have to sell for $800 versus you bought it for $1,000, you sell for $800, and that makes it equivalent to the 4% bond. So you took a 20% loss. In fact, 20-year bond is down as much as the NASDAQ is year to date, which is incredible. Bonds are considered safe, but they're actually they've been hit as hard as the NASDAQ has year to date because interest rates have gone up so much that they've really hurt bonds. That rising interest rates also hit stocks. So it's not called interest rates with stocks, it's called PE. The PE is the price to earnings, and that's how much you're willing to pay for a stock, right? And so when you have low interest rates, you'll pay a lot for a stock, but as interest rates go up, it also causes the PE to come down. So when you have low interest rates, you know, a PE of 24 is high, but it's sustainable. But when you have interest rates of 4, 5, 6, 7, 8%, that price to earnings multiple has to come down. And there's a relationship between the PE and interest rates and inflation. And so there's something called the rule of 20. Okay. And all it says is that you just take inflation plus PE. Okay. And if it's less than 20, that's a value. It's good. And if it's greater than 20, it's expensive.